Artificial intelligence is everywhere in 2025. Every investor, tech firm, and media outlet is touting it as the force reshaping finance. You'd be forgiven for believing AI already runs the financial world. But here's the twist. Despite the overwhelming hype, only about 2% of hedge funds globally have fully integrated AI into their investment strategies. That number is shockingly low. So why aren't the world's most sophisticated funds jumping all in on AI? To understand that, we have to look beyond the headlines and dive into the real-world challenges hedge funds face when it comes to machine intelligence. Hedge funds are not casual gamblers. They're managing billions of dollars for institutions, pension funds, and ultra-wealthy individuals. Every decision has immense consequences. And while AI seems like the logical next step, offering faster execution, deeper data insights, and emotionless decision-making, it's also wrapped in layers of complexity that many hedge funds aren't yet ready to untangle. It starts with data. AI systems require vast amounts of clean, structured, and relevant data to train their algorithms. But financial markets are noisy, erratic, and filled with unstructured information. Market sentiment, for instance, can swing on a single geopolitical headline or a viral tweet. How do you train a model to anticipate that? The very nature of financial markets resists predictability, making traditional AI modeling less effective than it is in fields like language or image recognition. Even when hedge funds do have the data, there's a second problem: explainability. Most high-performing AI systems, especially deep learning models, are essentially black boxes. They process inputs and generate outputs, but they can't always explain how they got there. For a hedge fund manager handling billions, that's a serious issue. Investors and regulators both demand accountability. Imagine being grilled by an institutional client after a massive loss and having to say, "The model told us it was a good move." That's not a sufficient answer. Clients need confidence, not just in the outcome, but in the process. That confidence erodes quickly when even the fund manager can't fully interpret the AI's reasoning. Then there's the legal side. Regulatory frameworks in the US, EU, and UK are increasingly hostile to opaque strategies. In the United States, the Securities and Exchange Commission has emphasized transparency and risk oversight, especially when algorithms are involved. If a fund using AI is audited, it must demonstrate how trades were executed, which data informed them, and whether the models aligned with risk controls. That's incredibly difficult when using neural networks or large-scale machine learning algorithms, which often can't be reverse engineered in a comprehensible way. A poorly explained AI decision could trigger compliance violations, lawsuits, or worse, asset withdrawals by anxious investors. The next issue is model robustness. AI systems are only as good as the data they're trained on, and history doesn't always repeat itself. Financial AI models often struggle during regime changes, moments when macroeconomic conditions shift dramatically. Think global pandemics, war, trade tariffs, or central bank policy reversals. If a model is trained on low interest rate environments and suddenly the Fed hikes rates unexpectedly, the entire investment logic could collapse. Traditional fund managers might instinctively hedge such risks based on experience. AI, on the other hand, may not adapt quickly enough unless constantly retrained, and that retraining process can't happen instantly. Even if a hedge fund overcomes these hurdles, another roadblock appears: cost. High-performing AI infrastructure doesn't come cheap. Funds need powerful GPUs, access to real-time data streams, advanced engineering teams, and constant maintenance. That's a major investment, one that only the largest hedge funds can afford. And even among the top-tier firms, few have decided the benefits outweigh the costs. Firms like Renaissance Technologies and Two Sigma have experimented with AI in specific modules, like improving data ingestion or automating market surveillance. But they haven't handed full portfolio control to AI systems. Instead, they treat AI as an augmentation tool rather than a replacement for human judgment. Meanwhile, we've seen a volatility wave hit AI-related stocks in early 2025. Hedge funds that bet heavily on AI sectors, including chip makers, cloud providers, and machine learning startups, have seen mixed returns. Some soared when demand was hot, Others crashed when investors realized that enterprise adoption was slower than projected. These swings created second-order uncertainty. If hedge funds can't even confidently invest in AI-driven companies, how can they rely on AI systems to run the funds themselves? But let's be clear, hedge funds aren't ignoring AI, they're studying it intensely. They know AI has potential in specific domains. For instance, natural language processing models can scan news headlines, earnings call transcripts, and social media to detect sentiment shifts before humans notice. Predictive analytics tools can flag abnormal trading patterns or preempt volatility in niche markets. Robotic process automation can handle the time-consuming back-office tasks like reconciliation or client reporting. These applications are non-invasive, meaning they support the investment decision-making process without taking it over. And that's where the adoption sweet spot is right now. In AI that assists, not replaces. Another reason hedge funds are treading carefully is cultural. The hedge fund world is dominated by seasoned investors who built careers on instinct, experience, and intuition. For many of them, turning over control to algorithms feels like surrendering the edge they spent decades cultivating. There's also a deeply competitive nature within hedge funds. No firm wants to be the guinea pig that lost billions experimenting with an AI strategy that backfired. In this space, reputation is everything. A single catastrophic quarter could lead to investor exits and fund closures. That risk is amplified when relying on experimental tools. And yet the arms race has started. As more data becomes available and as AI models grow more explainable, thanks to advancements in interpretability and causal AI, more hedge funds will cautiously deploy these tools. Some may start with hybrid models, combining AI insights with human override systems. Others will build in redundancy, creating shadow portfolios that mirror real ones and testing AI-generated trades in a sandbox before executing them. There's also an emerging interest in reinforcement learning systems that adapt through simulated market environments. Learning strategies over thousands of iterations, these tools offer promise, but they also carry immense responsibility. Looking ahead, the funds most likely to win the AI race will be those that build deep integration between data science and investment philosophy. That means hiring quants who understand markets, not just machine learning. It means building governance frameworks that allow for accountability, traceability, and adaptability. It means designing AI not as a magic solution, but as a powerful partner that works hand in hand with human expertise. Ultimately, the future of AI in hedge funds will be incremental, not explosive. It won't be a single revolutionary moment. It'll be a series of small integrations. Risk alerts here, sentiment scoring there, predictive models layered onto traditional frameworks. The funds that master this slow, methodical adoption will quietly build advantages over their peers. And one day we'll look back and realize AI didn't suddenly take over Wall Street. It embedded itself piece by piece until it was indispensable. So when you hear that only 2% of hedge funds use AI in 2025, don't assume that means they're behind. It means they're careful. Because in high finance, precision, not hype, determines who thrives and who crashes. It's all about today. Stay tuned. See you in the next video.